Okay, today we are going to be looking at something very important that many people fail to do, and that's financial planning. So today we are going to be working together on financial planning. I'm going to be showing you how to actually carry out a financial planning yourself, like a DIY. What are the things you need to consider for financial planning? So I titled this From Uncertainty to Clarity, a financial planning workshop. So now, most people don't fail financially because they lack intelligence. And also, it's good to earn a lot of money, but most people don't fail financially because they don't earn much money. Rather, most people struggle because no one taught them how to build a clear financial plan. You see people having a plan for their education. They will say, oh, by so year, I should be in, I should have graduated from college. By so year, I should be a manager, I should be a director, I should be a VP. They have a clear goal. That doesn't necessarily mean that they are just going to achieve every single goal, right? But at least they have a goal, and if they fail to achieve one of them, they can go back and see what went wrong and fix it. Again, people have goals for their marriage. People have goals for many other things. But when it comes to finances, many people do not create goals. Many people do not have a plan of how they want their finances to be. They don't, and because of that, they don't have adequate planning. So now, what do I mean by financial planning? So basically, financial planning helps individuals, businesses create a structured approach to managing their money and investment. They have a structure, they have a strategy of the way they want to manage their money, of what they plan to achieve. So effective financial planning lays the foundation for achieving financial independence and security. If you want to have financial independence, if you want to be financially free, if you want to wake up one morning and be able to do whatever you feel like doing without even thinking about the cost, then you need to plan their money. That's why you see the millionaires, the billionaires. They have what is called family office. They have it's like a what's it called, financial like an office, like a group of individuals that manage the money of a particular family. Like it's like a farm that manages everything for the family, right? So you have people like that, that they've already associated, they think they spend money to give structure to their finances. Now you don't have to have a family office. You don't even have to hire somebody to do financial planning for you. It's something that you can do yourself, right? So that's what we're going to be talking about today. Creating a financial plan is basically analyzing your financial situation to see how to create a plan to protect yourself, to grow wealth, and even to transfer wealth to the future generation. Now, why financial planning matter? Why am I encouraging people to create a financial plan? Why? What would be the benefit that financial plan uh, will give you, right? Now, I decided to show this, to show finances without a plan and finances with a plan. And as you can see, the images are below here. Look like, look how finances without a plan looks like, and look at finances with a plan. Now, let's look at it. What are the costs of not planning? If you don't have adequate plan for your money, adequate plan for how you want your future to be, what's going to happen? Disorganized account. You can have one account in one one company, one bank like that, you have another account in another bank, or you have investment account. One investment account with one brokerage, another investment account with another brokerage. And you are not able to like, okay, tell what asset do you have in what asset. Now, it's not a wrong thing to have accounts in multiple banks or to have accounts in multiple brokerage accounts, but there should be something that ties them together so that you know what you have. You'll be able to see the composition of all your assets. You'll be able to see like, okay, where do I have this asset? For example, I use at least maybe 3 or 4 different brokerage firms, but there's an account I log into, there's a place I log into, and I see all my accounts. It doesn't matter where they are, I see all my accounts. The same thing with my banks, with my bank accounts, my checking account, my savings accounts, they're in different banks, but I'm able to log. Okay, so let me see where I was. I was talking about what a financial plan gives you. I said it gives clarity about your finances. You know everything going on. It gives you confidence about your future. You have the confidence that, okay, the vacation you are planning to go on next year, you can afford it. It's not going to put you in debt. You have the confidence that when you retire, you have enough money. You can travel anyhow you want, and there's not going to be an issue. You don't have to work in retirement unless you choose to do so, right? Then it gives you control over your finances. You tell your money what to do. Your money does not tell you what to do. You tell your money what to do. Your money is your servant when you have a clear plan. Then you have roadmap for decision. You want to do certain things because you have enough money, because you already have planned, because you don't have to think about money, right? You have enough money to carry out that thing. Then you have the ability to think about the different options for that decision. Money is already out of it. Money is no longer a constraint for that decision. Then it reduces financial anxiety. This is a big thing. Some people receive bills, and in a month, some people receive bills, and that anxiety comes. And people always say that one of the things that common things that break marriages is finances. Don't you have a plan, your personal plan, a family plan for your finances? It removes the anxiety, or at least it reduces it. Then you have a way to align your money with your values and purposes. What are the things you care about? You are able to channel your money towards that goal. You have a cause that you care about. Maybe you are trying to you would want to eradicate poverty. Maybe you want to help the people in need. Maybe some other causes that you care about. When you have a plan, you are able to give towards it, and you align your money with your purpose. Now, what are the steps that you take to create a financial plan? In the next few slides, I'm going to be talking about the different things when you are creating the financial plan. What are the different things you have to do? The very first step in creating a financial plan is to define your financial goals and priority. What are the things that you have in mind to achieve? What are the things that matter most to you? What do you want your money to do for you? Do you care much about your family? For the people of faith, the Bible says that whoever does not provide for his family is worse than an infidel. You want to cater for your family. You want to take care of your family. That's a goal. Do you care about faith? Do you want to give to your church? Do you want to just give generously to people? Do you just care about financial freedom or security? Those are the things. You create a goal. You want to go on vacation next year. You want to purchase a home. You have a goal. for it, and you work towards the goal. Now, having said that, you should have 3 different categories of goals. You should have short-term goals. Those are the goals that you plan to achieve within 1 year. And those could include things like maybe you want to pay off debt. Maybe you want to have an emergency saving. Some things that need to be done within 1 year. The medium-term goals are the goals that are for 1 to 5 years. That could be something like, maybe you want to purchase a home. Like, okay, you say in 2 years' time, I want to have a home or my own home, right? You start saving towards your down payment. Then the third category are the long-term goals. The things you want to achieve 5 years plus, like retirement, like investment to build wealth, like long-term financial security. When you create goals, then you start working towards it. And when you are creating financial goals, well, any goals generally, there's a strategy you use called SMART. Your goals should be specific, not just something random. Your goal should be measurable. When it is measurable, that's how you can go at each point in time and check what portion of this goal have I achieved. Am I still on track to achieve this goal? Then this next thing, the T is time bound. There must be a time for that goal. For example, you can say, I want to be able to buy a house in 2 years, and you start working towards it. Then the next thing is, it has to be realistic. You want to make sure with the resources you have right now, do you think you'll be able to do that? If you're earning, let's say, 80K, for instance, you don't want to create a goal that in the next 1 year you want to buy $1 million house. With your current financial situation, it's not feasible. So you have to make sure that it's relevant, right? And it's realistic. Oh, I talked about time bound. Time bound was supposed to be the last thing. SMART, specific, measurable, achievable. R, is it realistic? I forgot. Then the T is for R is for relevant, rather. It must be relevant to you. Then T is for time bound. Now, the next thing is to know your numbers. When I mean your numbers, I'm talking about having a budget. I'm talking about creating a cash flow, having cash flow management. Now, the first thing you need to do to be in control of your finances, to be able to create a plan for your finances, is to create a budget. Budget will put you in control of your finances. Budget will tell your money what to do. And you can manually create a budget, or you can use a budgeting app. There's different Excel templates that you can download, and you can create your budget. You create a budget of, like, okay, what you itemize your income, and you itemize all your expenses. So you tell your money every month, this is where a certain amount should go into, let's say, transportation. A certain amount should go to bills and all of those. So you tell your money what to do. Then the other thing is tracking income and expenses. Now, you've created your budget. That's the first one. But a budget that you have created that you don't track, that you do not monitor, is as good as not creating the budget at all. You look maybe every month, if your budget is every month, at the end of each month, you look at it, you track it. Did you spend your money the way you have allocated it or not? And if in any category you spent more than you should have, try to, maybe you did not budget well. Maybe you budgeted too small amount for that category, and then you can go ahead and adjust your budget. But if you budgeted adequately, something happened, you can look at what happened and try to prevent it in the future. That can only be possible when you track it after you've already created your budget. Then the next thing is cash flow management. Now, somebody could how do I put it now? Could be wondering that, okay, what's the difference between tracking my income and expenses and then cash flow management? That, okay, they are similar, but they are not exactly the same thing. But before I go into cash flow or monitoring, let me say one more thing about tracking income and expenses. Now, I did say that you can do it manually or you can use a budgeting app. Each one has their pros and cons. If you do a manual budget, especially if you look at you use Excel, sometimes, most of the time, you don't see something until it has already happened. You may not be able to catch something easily until after the end of the month. That's why the manual one may not be the best. But on the other hand, if you want to use an app, you may need to pay for it. So if you don't want to pay, do manual. But if you are able to pay, a budgeting app could be better, so that you see at each point in time during the month, you can see what where you are with your money. Then let's go to cash flow monitoring. Now, while tracking looks at the past, you look at the previous month, you are looking at your income and expenses. You look at the previous month to see what went wrong, to see did you do well or not, and how do you adjust it. Cash flow monitoring actually is forward looking. It's like active financial management. It tells you what your money, when money is expected to come in. It tells you what bills and obligations that you have coming up. It tells you whether you are likely to have a surplus or shortfall. It tells you if you are saved, if how much you are able to save, how much you are able to invest and spend. It is forward looking. And it is especially good to be able to project into the future, to be able to tell that, okay, in 5 years' time, okay, I'm good today financially. Will I still be good in 5 years? In retirement, will I still be good? Actually, part of creating a financial planning is to do a projection into retirement, to be able to tell, first year of retirement, do I have enough money? Second year of retirement, do you have enough money? Throughout my retirement years, do you have enough money? What would be my inflow? What would be my outflow? So you actually do cash flow monitoring. Then the next thing, emergency fund. This one cannot be overemphasized. And personally, I think when you want to have a hold on your finances, this is where you start, to have an emergency fund. The recommendation is to have 3 to 6 months of expenses in your emergency fund. But I quite understand it. Not everybody is at the same level financially. Maybe you hear 3 to 6 months and you just think, this is not possible. How on earth am I going to get 3 months of expenses? But start where you are. If 1 month is what you can start with, put it in an emergency savings account right now. And then start to build it up gradually until you get to 3 months. You get to 3 months, try to build it up gradually to 6 months. And 6 months should not necessarily be a cap for you. You can definitely exceed 3 months. You can have 9 months. You can have 1 year, depending on your goal. For example, if you are planning, let's say you are starting your own business, you are planning to retire, it might be a good idea to have, let's say, 1 to 2 years of expenses already in your account before you think of retirement. Then the last thing here is to avoid debt. Debt can put a lot of stress on your finances. Try to avoid it as much as possible. But having said that, all debts are not created equal. Like, there are some debt, you hear people talk about good debt and bad debt. There are times you go into debt to be able to finance a business, and you know you are going to get returns from that business. That kind of debt is okay. You have to go to school, for instance, and you are taking student loan. That's still okay. Although if you can avoid it, it's fine. But if you cannot avoid it, that's still okay. because you are going to graduate and you are going to start making money. That's good debt. But there are certain debts that you should avoid at all costs. For example, credit card debt. Like, you have something, you want to buy something, if you are not able to afford it right now, it might be better to wait on and save up for it rather than going into the credit card debt. And it's so sad that many of these credit card debts carry so huge interest rate. Some people pay like 30% interest rate. That's 35% interest rate. That's ridiculous. So what you want to do if you are in debt right now, you want to try to get out of debt as soon as possible. And if you are not in debt, you want to avoid it as much as possible. Now, saving and investment planning. People say that to fail to plan is to plan to fail. It's not just investing. Like, I always encourage people to invest, but that's not just enough. You should have a plan of how you want to invest. You should have a plan of the different things that you want to invest in, right? Now, having said that, when it comes to savings and investment, the most important thing is the consistency. Every month, you should have a certain percentage of your income should go into saving. A certain percentage of your income should go into investing. You want to make sure that that happens either every month or every 2 weeks or every week when you get paid. If you are not able to hold yourself accountable, find somebody to hold you accountable. And if you know, for me, I know that I can't trust myself that I won't always forget. So what did I do? I automated my saving and investment. When I get paid, before I even see it, the money automatically transfer, a certain percentage automatically transfer from my checking account to my savings account. Another percentage automatically transfers from my checking account to my brokerage account. I don't have to think about it. I don't have to go do it manually. That keeps me consistent. And that is how to build wealth. That is how to make use of, to let compounding work for you when you are consistent. Now, the next thing is the different asset classes. You have different asset classes I believe last month we talked about the different asset classes like stocks, bonds, precious metals, you have real estate, you have cryptos, and so on. Now, you don't want to put all your eggs in one basket. You want to invest in different asset classes. Maybe even CDs. Maybe you want to have some money in CDs. You want to have some money in bonds. You want to have some in stocks, some in real estate, and so on. So that if in a particular economy, one asset class is not performing well, another asset class will perform well. And thereby you're able to grow your wealth. The next thing, one thing before I leave that is that asset classes have different risks and they have different performances. So before you decide what asset classes to invest in, look at their risk, look at their historical performance. Although past performance does not necessarily guarantee future performance. Now, the next thing is risk tolerance. I just told you how different asset classes have different risks. Before you invest, look at your risk tolerance. If you lose a certain amount of money today, let's say for instance, you invest $1,000. If you lose it, is it going to keep you up at night? Maybe $1,000 is not going to keep you up at night, but maybe $5,000 is going to keep you up at night. Maybe $10,000, $50,000 is going to keep you up at night. Look at your risk tolerance to be able to decide what asset class do you want to invest in. For example, for me now, I know a lot of money. People make money on cryptos. I know it's legit, but I do not do it because it's volatile and I'm not ready to. I look at my portfolio every single day, and I don't want to look at my portfolio and start looking, oh my God, I've lost a lot of money. No. So I don't invest in it directly. Although I have crypto ETF, I don't invest directly in cryptos. So manage your risk. Do not invest in an asset just because somebody says, oh, an asset is good, they have made money on a specific asset. Don't let that be the basis for which you invest in an asset. Let it be because you know that, okay, you are able to tolerate the risk for that specific asset. But having said that, one thing I want you to know is that the higher the risk, the higher the potential for return. If you are the type that does not take risk at all, maybe you want to put your cash in high-yield savings account. But maybe at most you are going to get 4%. But if you put your money in stock percent, maybe an average, you get an average of 8% per year. Some years you get more. If you invest in some other asset like cryptos, maybe you get more. So just the timing with the level of risk you are able to take, that can tell you how much was like the potential for your return. So create a strategy for investing, and when your strategy should include your risk tolerance. Then the next thing is tax awareness. Part of the things you look at before you invest in an asset is the tax implication of that asset. I mentioned the different asset classes earlier. They don't have the same tax implications. Some asset classes, they have capital gain taxes, which is low. Some other asset classes, your taxes will be ordinary income taxes. So look at the tax implication of your asset. And within each asset, look at the different ways you can lower your taxes. For example, if you invest in stocks, you can do tax loss harvesting and not only lower your capital income, you can even lower your ordinary income. Then the last thing, tax awareness, it's like a session on its own. Maybe one of these days we'll focus only on taxes. Then the last thing is diversification. You want to make sure you have the right mix of assets. When you are working towards your retirement, you want to make sure that you have the right mix of like what's it called, retirement account based on tax. Like, okay, is it tax deferred? Is it the taxable? Is it the one that or is it pre-tax? You want to have the right mix. Within the same asset class like stocks, you still want to diversify. Maybe you invest in different geographical location. You have stocks in the United States or stocks of companies in the United States. Maybe you want to have stocks of international companies as well. Maybe you want to have invest in different industries. So that's very important. Now, I have this here not because I want to shame anyone. In natural fact, I cover the name of this person so that you don't see the name. But I have this here so that no one else will have to go through what this woman is going through right now. I saw this a few days ago. 87-year-old woman who works 2 jobs because she cannot afford to retire. It's okay if you retire and you feel like you just don't want to sit down at home, you want to take up something. But if you are not that type, enjoy your retirement. You should be able to enjoy your retirement. You should be able to stay, travel around, not have to work when you don't need, when you don't want to work. And how can that be possible? How can you make sure that you don't work in retirement when you don't want to? That is by planning for a secure retirement. You have retirement planning. The moment you start earning income, you should start working towards retirement. Maybe your retirement is still 50 years time. Maybe for you it's 20 years time. Maybe for you it's 10 years time. You don't want to wait until you start having retirement account. So the earlier you start, the better. And when it comes to investing, there's something called compounding. Compounding means when you invest or you save, the interest or the return you get in turn gets returns as well. You put $100 in an investment. At the end of 1 year, you get, let's say, $15 return. In the next year, your return will not be based on the initial $100. It will not be based on the $115 that you have right now. That's compounding. And with compounding, the earlier you start saving for retirement, the better. Now, you need to have retirement accounts. If at your place of work they offer retirement account, make use of it. Like 401k, 403b, make use of it. Some employers will even have what's it called, matching. Some will match for your 2% that you put in there. Some will match 4%. Make sure you contribute enough to be able to get the matching. Then even apart from the workplace retirement, you can still have a retirement account for yourself. You can have a traditional IRA, you can have Roth IRA. But those are especially good for people whose companies do not offer retirement account. So you want to make sure that you are contributing to your retirement account every pay period. And not just that, with how much you are contributing, you should have a projection of how much you are going to have invested at retirement. Year one of your retirement, how much are you going to have? That's part of the retirement planning. It's not just putting money in retirement account, but have a projection of what your investment will be in retirement. And that can help you to determine, are you putting enough money in retirement right now? In retirement account right now? Or are you not? The standard recommendation is to put at least 15% of your income in retirement account. But again, I get it. You may not be able to afford that right now. Start where you are. Maybe every year, maybe you are starting with you start with 5% right now of your pay, and you can increase it by 1% every year until you get to 15%. And again, 15% should not be your cap. You can contribute more. Education. This is really, really important for you and for your children. If you should start planning the moment you have a child, you should start planning for that child. Like, okay, what's going to happen when the child gets to college? How are you going to pay? One very nice account for education is the 529. It's tax advantaged, and it's best for long-term growth and college planning. And with some recent development, if the child decides not to go to college, you can transfer it to other children. Or you can even, I believe, up to 35,000 can be rolled over into an IRA. Another one is Coverdell. But with Coverdell, it's more flexible for like K-12 expenses, but it's capped at 2,000 per year. You can not put in more than 2,000 per year. Student loan, like, okay, this should, if you have, one thing is this, I understand some people just have to take student loan. But if you have taken student loan, do you have a plan of paying it off? Do you have a plan so that it doesn't become a huge debt for you? That is really, really important. You should have, if you have to take student loan, you should have a plan for it. Then the last one here is the UTMA, like Uniform Transfer to Minor Act, Uniform Gift to Minor Act. This is not education specific. The child can use it for anything they want. But it's not as tax friendly as 529 and covered up, but it's also good for long-term financial stability. Now, risk management. You want to make sure that you are protected, that you are protecting your financial future, and you use the different insurance products that can help you, like health insurance. I want to make sure that you are protected against medical expenses. Medical expenses has put a lot of people in debt. So you want to make sure that you have adequate health insurance. You want to make sure you have life insurance. You are providing financial security for your dependents, just in case something happens. Then you need to have property and casualty insurance. You are protecting assets like homes, like vehicles. Now, I just talked about insurance, and it's not just insurance. If you're for everything I've been talking about, you need to have a needs analysis to be able to tell if your money, your contribution right now is going to sustain you in retirement. You need to have a needs analysis. How much do you think your expenses will be every year in retirement? You need to do that. So, and when you are doing needs analysis, you can use the present needs to project into the future. Some people follow the standard of, okay, 85% of their present expenses will be their expenses in the future. Maybe by that time they've already paid off their mortgage, they don't have mortgage, so their expenses will reduce. So you need to look into things like that. You need to consider inflation. $1,000 that you have right now will buy more than $1,000 will buy in the next 20 years. So you need to consider inflation when you are doing your needs analysis. You need to consider present value and future value, and that's part of the inflation. When you are doing your needs analysis, you think you need 80,000 per year in retirement. Is it based on the present value of that 80,000, or is it based on the future value? You have to determine that. You have to consider mortgage payoff as well. You have to consider downsizing. Maybe you are living in a house right now. In retirement, you want to move into an apartment. That should be part of your analysis. Now, it's very important that you don't just create a plan right now, but there should be financial monitoring and adjustment. The plan that you have today may no longer be good 5 years down the road. So it's very important that at least every year, review your plan and adjust adequately. When there are new goals, when there are life changes, let's say there's a new child, maybe you get a new job that has changed your situation. When you review your plan, adjust it. Then you may need to rebalance investment. You have your investments in some asset classes. Maybe at this point in your life, certain asset classes are no longer useful. For example, right now, I'm able to take a lot of risk. I put most of my money in the stock market. 5 or 2 years to retirement, I cannot take the kind of risk I'm able to take today. So there's a need for rebalancing as well. Then you need to be tracking your spending. I already talked about that in budgeting. Now, having said that, you are definitely able to do financial planning yourself. And I've giving you the basics of how you can do it. So do it yourself, financial planning. It can get you organized. It can help you to build awareness. It can help you to move in the right direction. But having said that, I would recommend a comprehensive financial plan that includes how to optimize your taxes, how to coordinate investment between different accounts, how to protect your family, building retirement income, planning for colleges, own businesses, to avoid costly mistakes. There are people who are trained to do a comprehensive financial planning. So they can help you to avoid costly mistakes, because there are mistakes that you can make that they are not reversible. Like, yeah, that once you make such mistakes, it's a problem, right? So and then they can help you to stay accountable. So having said that, for us at Ivorian Financial, we help people to create comprehensive financial plan. So at Ivorian Financial, what does our process look like? We meet with you, we discover you, we discover your finances, we discover where you are right now. We get a lot of information from you. You know, there are things that we need to, we have a portal where you're going to enter certain information apart from the one we collect from you. So we go back and we analyze your data. When we analyze your data, we are able to create a plan for you. Okay, part of the plan is your tax strategies. What do you need to do to reduce your taxes? Part of the plan is, okay, when you retire, when should you take Social Security? Part of the plan is that should you even do Roth conversion at all? And if you should do Roth conversion, when should you do it, right? Then we help you to implement it. There are things that we can implement for you. There are things that you can implement yourself, but we guide you and we then help you to monitor and adjust appropriately. So before I show you the last slide, let me just give you like a snippet of what financial planning looks like at Ivorian Financial. If you can see my screen, I'm not able to give you an actual client financial plan. You know, it's confidential. Like if you come to us for financial planning, whatever we do for you stays between you and us, right? It doesn't, nobody else should see. So that's why I'm not able to show you an actual client financial plan, but here I've created a sample for you. Even though it's not real data, it's a realistic data. As you can see, I hope you can see my screen. You know, something we created at Ivorian Financial that was generated yesterday, right? And look at this. This is a 127-page document of somebody's financial plan. That's why I call it a comprehensive financial plan. We go into details of what the person should do. And if you look at this page right now, after all the things we created, if everything is adequately implemented and monitored, the person will have 98% chance of success. Meaning 98% chance that when you retire, you're not going to run out of money. 98% chance of that all the goals that you have, you are able to achieve it. So we look at that. We looked at the net worth, and if you can't see my screen, please let me know. But I believe you should be able to see it. So we look at everything. We look at their liquidity, and we help them with their budgets. This doesn't show in this report, but on the portal I have a portal where I'm going to give you access to. You'll be able to see create your budget there, and then we have asset allocation. We look at the current allocation of that client, and then we, depending on the goals of that person, we create another allocation for you. For this person, for example, the person wants to be able to preserve capital. This, even though this has higher in return, but the person needs to is more concerned about preservation. Because of that, we created something that will preserve it. It has lower return, but it has lower standard deviation as well, meaning the risk is lower. So we do that. We do look at the different asset allocation. We check if the person has concentration in too much concentration in certain stocks. Like this person has too much concentration in Johnson and Johnson, right? So we see the concentration, we can tell the person that, okay, liquidate this volume of that specific, this amount of that asset. We look at the taxes, like, okay, what are the different tax bucket, the taxable asset, tax deferred, tax free, and the things like that. And then we can propose. This person initially, before implementing the current allocation, the person only has 79% chance of succeeding. But after implementing everything, it jumps to 98%. So we looked at the different goals, we looked at proposal, we looked at savings analysis. We can see that if the person continues to save or the recommended amount, at the time when he retires, it's going to have 9 million in investment assets, 1 million in savings. We look at all of those. We create retirement needs analysis. We propose the plan. There are just a lot of things that are in this. We look at their cash flow. We look at Medicare and all of those things, the enrollment, a lot of those things. We look at cash flow. Where is the money going? The person is making 180K. Okay, what are the expenses? And for the expenses, where is the money going, right? We look at all of those things for the person, and then we are able to create a plan for the person. We looked a little bit into like estate planning as well. Like, okay, we should inherit money, we propose how the estate should be planned as well. So yeah, we just create a comprehensive plan. So thank you so much for attending this session. Again, this is something you can do yourself. But if you need something more comprehensive, please feel free to reach out to us. You can send an email. You can reach out to us on the number and on our phone number. Sorry that this broke into 2 lines. And then you can check out some of our videos on YouTube. They can help you to be able to manage your finances well. Having said that, we have 7 minutes. Any questions? Anything? Any thoughts, questions, anything? Feel free to unmute yourself.
Could you explain a little bit more about the difference between like 401k, Roth, Roth IRA? Still kind of often confused about them.
Okay. There is a very wide range of retirement accounts available. But the ones that are very popular are 401k, 403b, 457, traditional IRA, and Roth IRA. Now, if you are working in a company, most companies have retirement accounts that everybody contributes to. You can opt out if you want, but they contribute to. Most of the time, it is 401k. But for some organizations, like maybe non-profit, like hospitals, like education, maybe churches, they have 403b. 401k, you contribute from your pay period. Each time you get paid, a certain amount or a certain percentage of your income will go directly, will be taken before taxes are even, it's pre-taxed, before they take out your taxes. Your tax contribution will directly be deducted from your pay and transferred to your retirement account. Now, there's a plan manager that manages your account for you. They have a range of options. Like, the law is that they should have at least 3 options that you can choose from. Some of them have target date funds, like, okay, for people who want to retire in 2052, for instance, they have a fund for them. For people who want to retire in 2050, they have a fund for them, right? So it's like a pooled income or a pooled, what's it called? Investment, sort of, right? So you put your money, you assign that a certain percentage should be deducted, and each pay period it gets deducted. They buy mutual funds for you. You can log into your account, see the performance of your account. That's 401k, that's 403b, right? But for people who do not have that opportunity, you're working for a company or you're working for yourself, you don't have opportunity for 401k, 403b, 457. you are self-employed. You have the option of creating IRA. IRA stands for individual retirement accounts. And there are two types. The traditional IRA. For traditional IRA, it's pre-tax. Even if you are self-employed and nobody takes it from your income pre-tax, what happens is that at the end of the year, when you want to file your taxes, any contribution that you have made to a traditional IRA, you can include it in your taxes to lower your taxes so that you are not paying for that. On the other hand, the Roth IRA is that the money you've already paid taxes on. And one advantage with a Roth IRA is that I can already be contributing to 401k. I can still do for Roth IRA, although it depends on my income, right? If my income gets to certain amount, I can no longer contribute to what's it called, to Roth, right? So
Okay.
Roth is pre-tax. I mean, is already you already sorry, post-tax. You already paid taxes on it. You put your money in Roth, and your money grows tax-free. As long as you don't take distribution from it until you get to the age of 59 and a half. When you don't pay tax yearly on it, when you now take your money, when you make distribution after in retirement after 59 and a half, everything is tax-free. You will not pay. Let's say you put 10,000 in Roth, for instance. Your 10,000 grows into 50,000 in retirement. That entire 50,000, you take it from your account without paying taxes. For traditional, on the other hand, since you did not pay taxes at the beginning, when you retire, you will pay taxes on it. And the taxes you pay at that time is going to be based on your income. It's going to be like ordinary income tax. That's why I always recommend you should have a mix of both. So, but usually, if you think that your taxes will be higher in retirement, maybe you need to put more money in Roth that you've already paid taxes in. Now, but if you think your taxes will be lower in retirement, then than it is right now, maybe you want to put your money in traditional. But besides those, there are some other kinds of retirement. They are not popular, but yeah, it's a wide range.
Okay, sounds good. Thank you so much. Thanks for
Oh,
clarifying the Roth aspect. Thank you.
you're welcome. Any other questions, any thoughts before we end the session today? And by the way, at Iverian financial planning is not the only thing that we do. We help people with investment management as well. You know, again, it's okay to do it yourself. The most important thing is that make sure you are investing, whether you do it yourself or you use a financial advisor. But if you do not have the knowledge to be able to do it yourself, if you do not have time to be able to do it yourself, you've not been able to create a good strategy to be able to invest for yourself, use an advisor. And at Iverian Financial, that's one of the things we do. We help people to manage their investments. And apart from that, we also do what's it called, seminars just like this that we do every month. We go to different organizations like churches, and then we'll sensitize them, we'll help them, we'll talk to them about investing. We pick different topics depending on what they want, and then we enlighten them. Any last minute question or thoughts? Okay, all right. So we are going to end this session here. Thank you so much for attending this session, and we will also invite you in the future for other sessions as well. Let's just pray. Sorry.